And when you think about the current state or landscape of institutional adoption in the space, how would you frame that for the audience? Again, you've been at this for, let's call it a decade or more, right? So I'm curious how you would describe the current state of institutional adoption and how that has evolved in the most recent 12 months.
It's a great question, but I think that maybe some context need to be explained before. So I think that the question is, what in our view is required to have institutional adoption? And I would say that currently institutional adoption in crypto is for the most part trading crypto, right? Like there is no real scale around on-chain finance. I think that our view, and now you'll see a lot of people talking about that, there's a few elements, but maybe two in particular. I think a lot of times people said that the reason there was no participation on chain is because of scalability. I actually think that scalability is not the issue. As we've seen with every technology, if the technology proves the business use case, scale will come. Similar with cell phones. Eventually, technology will pick up the performance that is needed to supply the demand. A thing that I think most other crypto offerings haven't been thinking about early on is, for example, if you're a large scale institution, you don't want your peers, your competitors to know what it is that your business does. That's your IP, that's your competitive edge. If you're a publicly traded company, there's a lot of analysts or hedge fund analysts that are really trying to kind of back calculate into what is your activity. Now imagine you just put all of that on chain for everyone to see. One of the things that we've always thought about is privacy. Now you'll see a lot of people talk about privacy today. We don't believe that they're necessarily using the same type of privacy we talk about. Again, for us, privacy is the ability for people that have no stake in a transaction to know that that transaction took place, but for you still to be able to comply with regulation, be able to share information with those that need to audit you. That to us is privacy. So that was one component. And then the other one is, and this is, I don't know if this is going to be controversial, but, a lot of times people say, one of the advantages of crypto is that it's immutable. And I say, yeah, crypto is immutable until a hack happens. And then we kind of reverse the hack and, nobody talks about it. Yes, it happened. But the reality is when you think about wanting to bring real world assets on chain, one of the challenges is that if we really want to have institutional activity, we really have to bring the actual asset on chain, not an IOU, not a wrapper, the actual asset. Because if I am Capital Group or Wellington or Citadel or any one of those institutional players, if they're holding equities, they want to know that they are holding the equity, not a representation, not a derivative of the equity. Because at the end of the day, when things go bad, they want to know that they have the actual asset. And the reality is, in order to do that, one of the things that make DeFi so powerful is that I can deliver assets into a DeFi protocol in real time for a few cents. And what you call in traditional finance, I perfected the security. That is the only books and record of an asset is the chain. DeFi is really cool, right? I can do all of these things in real time for almost no money. The problem is that you want to have the same experience on real world assets, and therefore the chain need to become the de facto books and records of an asset. So when we went to build Canton, we didn't ask, how do we create yet another faster, cheaper consensus? But we actually said, no, what are the first principles that this chain will be able to satisfy? Meaning an issuer would be able to trust that this is the books and records and no third party can meddle with it, whether it's via 51% chance attack and things like that. Like they know that they have full sovereignty and control over their books and records. And therefore they're comfortable saying the chain is the books and records of my asset. You have privacy and all of those things. So I think that it was more of coming at it from really thinking from like first principles of what will be needed to truly conduct on-chain finance. And then the next phase was, okay, now let's actually go and test that with clients. So I think that, there's a few examples, but like we have clients like Broadridge that are doing now $400 billion of repo every day. Now, a lot of times people in crypto don't believe me because, 400 billion, it's almost kind of like the entire crypto volume when you think about crypto asset. And I try to explain to them 400 billion is not enough. It's not even 10% of the repo market in the US alone on a daily basis. But that being said, it is close to 10% and it's real. We work with iCapital, which is the largest feeder fund provider that are moving feeder funds natively on chain. We have life insurance, annuity companies that are issuing these products natively on chain, mortgages, on, and on. And then the one that is very exciting is we did a project with the DTCC where now you can hold a US Treasury at the DTCC natively through Canton. So, that's just maybe a taste of some of the institutional use cases that we've been working on.
What's been the biggest challenge when you speak to institutions who may be either, let's call it blockchain skeptical or just blockchain, maybe like undereducated? What do you spend most of your time unpacking for them? Is it the privacy aspect? Is it the security aspect? Which aspects do you find that you spend the most time educating folks on?
I think that one of the biggest challenges in crypto is that a lot of already existing capital market products just get reinvented. The marketing is great. I'm truly very excited. But the reality is that, again, if you think about it from the lens of an institutional player, they have fiduciary responsibility to their investors. This is not just retail playing or trading or investing with their own money. You have fiduciary duties. And as a result, you expect them to be more cautious than participating with their own personal money. And when you go and you create all of these new terms, I'll give you an example: looping, leverage, staking, securities lending, yield farming, structured products in all kinds of like covered calls. And these are great names that have created a lot of traction. But then you try to go and explain the difference to a large institutional player. So there's a lot of education, first of all. Second of all, I think that because marketing needs to be concise, people will just say privacy, or people will just say tokenization. Well, clearly not all tokenization projects are created equal. There are some people that do tokenization in a very risky way, and there are those that do tokenization in a really safe way, but they both call it tokenization. And I think that this massive influx of these terms and people that are using the same terms to do things different, requires a lot of education. So I would say that a lot of times, most of my time is being spent on trying to explain the nuances between all the different approaches and the different words.